You are listening to the Yield to Reason podcast, where we strive to help you build the most important part of your retirement strategy. Because a retirement plan built with robust income sources is a retirement plan built for success. I am Brandon Roberts. This is episode number 4, and today we're diving deep into a discussion about closed-end funds with special guest Steve Selengut. It's time to give you some serious firepower as we set off on a journey to help you build the retirement you deserve and the one you actually want. Steve Selengut is the author of Retirement Money Secrets, a book dedicated to showing you how income-focused investing can change your life and your retirement prospects. Closed-end funds sit at the center of Steve's investment strategy, but it's not just a recommendation to buy closed-end funds and call it a day. Oh no, there's plenty of additional strategy outlined to boost income and protect you from the volatility of business cycles. Professionally, Steve managed assets as an investment advisor for decades, employing these exact strategies to help his clients, who entrusted him with over $100 million of their hard-earned money, build substantial investment income. Steve, welcome to the Yield to Reason podcast.
Thank you, Brandon. It's nice to be here.
So we've got way more questions than we realistically have time to address fairly, but we're going to do our best. So I want to start philosophically. I want to get the story on what started you down the road of focusing your efforts on income-focused investing.
It's a long road. It's a long road. Actually, it may even have started before I actually had any money to invest. My dad was a real estate developer / landlord / the whole 9 yards. He had a vertically integrated real estate. You could almost call it an empire, because at Lake Apacon back in the 1950s, he was pretty much the only major developer in the area at that time. So, long story short, we were always encouraged to work, when we were off from school and stuff like that as children. And he would take some of that money and he said, I was putting this aside for you so that you learn how to develop income other than salaries when you get older. That's basically what he said. Even if it was just watching the interest compound in your savings account, that type of thing. So anyway, he had developed these many streams of income. And I knew that, and I saw the lifestyle it produced and so forth. So somewhere back in my head, it seemed to always be there. When I was my 25th birthday, I was handed a portfolio of stocks. Literally, certificates were dumped out on my desk, in front of me, and I was looking at pieces of paper that represented shares in General Motors, Esso, other oil companies, GE, Sears, Roebuck at the time. And that was the result of money that my brother and he had a similar event. I'd given him over the years that he, or actually his attorney, had invested for us. And at age 25, he gave us all the money. And it was substantial. In those days, it was nearly 6 figures, and that's in 1970. So
in real dollars, we're talking dollars. We're talking a lot.
This is when gasoline prices were still under $1. You know what I mean? So anyway, it was a long time ago. It was a lot of money. My main interest was not losing it as much as anything else. The stocks themselves were all dividend payers. Which was in line with his ideas and which became mine. They were all big name companies that you recognized. I handed them off to, at that time, a rarity, a woman broker. Okay. They just weren't around back then.
Yeah.
She wasn't a young woman, but she was, she'd been doing it a while, and she sort of took me under her wing, so to speak, and helped me with my objective of not losing it. And we started, everything was invested. The dividends would come in. I'd be getting the dividends. In those days, you got checks in the mail.
Yep.
And I'd give it back and I'd reinvest it. but we studied the markets. We studied how the prices moved, even with the best of the best companies. Even with a General Electric, the price went up and down. The price went up and down. The range was not, it wasn't actually predictable, but you knew it was going to go up and down, and it always looked like it had a higher high and a lower low, or a higher high and a higher low. So the trend was upward. The economy trend was upward in those days all the time too. So we said, or I said, why don't we set a target price, sell them when they go up 10%, watch them, and when they fall down in their cycle, their normal cycle, down 20%, let's say, from their 52-week high, we buy them back again and do it again and again and again. And that's what we did. And we expanded our base. And she said, your portfolio is a big portfolio. You need to have income-focused securities in there. There are these things called municipal bonds with tax-free income. I think you should start looking at those. So my first Fort Pierce, Florida, 4% coupon municipal bond was purchased. And then we bought more individual municipals, not full, not 50 grand at a time, but, small pieces, 3,000, 5,000, so forth. And another product we used for income were Ginnie Mae's, Government and National Mortgage. And they had these things called bond unit trusts that you get back principal and interest. So the income was flowing from everything I owned. And I was trading.
And this all started when you were in your 20s.
This was when I was 25. I started this process. And within 9 years, 1979 or so, it was a little bit before then, because in 79, I actually quit my job and started doing it. But by 1979, I was making 5 times my salary in income from my investing. And to be honest, it was as much from the profit taking as it was from the dividends themselves.
Now, let me ask you, this entire time, you basically inherit this money, or you're gifted this money, and you start investing it, and from where you come at this, just thankfully having the basis of focusing on income all along. And then, of course, the advisor who is suggesting, let's do these various other things.
Right.
Did you ever stop and look at this and worry about how big the balance was?
Well, what I was looking at was, we were looking at, and I hadn't even put it in the proper terminology yet, but everything we did was the highest possible quality. In those days, only the best companies paid dividends. And it was high quality. We were diversified. We had something representing pretty much every sector you could imagine.
Right.
So everything produced income. And we were taking profits. Today, in my book, Retirement Money Secrets, and just, this is it, Retirement Money Secrets. In my book, the 4 of the 6 basic principles are quality, diversification, income generation, and profit taking. This is how you minimize risk. This is how you keep yourself in a safer environment. All those things put together create that safety, so you can focus more on the income you're earning and the process of taking the profits and reinvesting. Then you have to worry about the ups and downs of the market, because when you study the market cycle, you see that there's always going to be ups and downs.
Yep. Yeah. And I asked that question because I want to underscore the point that here you have a sum of money, and there's a lot of traditional advice that talks about what you should do with that in the pursuit of, you need to be allocated in certain things that are going to grow because you're young and you can afford the risk profile that represents. Here you receive this money, you don't effectively do any of that, and instead start collecting substantial amounts of income way in excess of what you were earning from your wage activity. And it sounds like, I don't want to put words in your mouth, so you can say this or confirm this, but it sounds like you didn't really worry much about balance of the account. You were looking at the income coming in thinking, this is great.
Right, because that's what we were focusing on. And I was I was probably the most fortunate thing I ever had was the initial advisor I had, who said, pretty much, I agree with what your initial impression was. I don't want to lose it, you know? So you've got this high quality portfolio. We're going to get you income. We're going to stay diversified. All these things she did. She didn't ever say, well, there's a new issue coming out. We should try that. You know, in the old days, in broker terms, you used to have this thing called the stock of the day. Yep. Merrill Lynch, I think, is the one that actually put this into operation. And every day they'd have a phone meeting or something, and the boss would get, we are bringing this one to market, and every broker's got to call every client and sell them some shares of this particular stock, the stock of the day. And it didn't matter what the hell it was. Yeah. Excuse me. It didn't matter what that stock was, what industry it is, whether or not it paid a dividend. It was the stock of the day, and that's what those guys were being paid to push down your throat.
Yep. So
that's the way it worked.
So where do closed-end funds enter this story?
Oh, well, actually, the first two closed-end funds that I used entered the story probably in the 80s.
Okay.
And they were the symbols are still alive, ADX and PEO. And these are not recommendations of any kind. This is a history lesson. These things existed back in the 80s when I was looking around for securities, and I was always looking for securities that paid significant income. And I was attracted to these two, and I didn't know a closed-end fund from anything else. Mutual funds were not nearly as popular in the early 80s and the mid 80s as they are today. There were no IRAs. There were no 401ks. There certainly were no ETFs. And I had never heard of closed-end funds. And I don't think Rita had ever heard of closed-end funds either. Okay.
Rita being the advisor.
Rita being the advisor I was working with initially before I started my business.
Yep.
So this was after I was in business. And so I discovered these two, ADX and PEO. One was petroleum and resources. And the only thing it invested in, it was a fund. And I knew it was a fund, but I didn't know what a closed-end fund was really. But looking inside, it had all the major oil things. And back in those days, these were the days when there were so many consolidations of all the individual oil companies around the country. Boone Pickens was consolidating all these things, and one after the other would be taken over with huge gains. Well, all of those companies were in this particular fund.
Okay.
So, and it paid quarterly dividends of like 5 cents. And then at the end of the year, it would pay a special dividend that was more like $5. Okay. So it paid enormous. So what I did was I would buy it in January, February, whatever, and I would keep accumulating it, not to a huge position, but same with ADX. They both were the same type of thing. And I'd wait until September after they announce their year-end dividend, September, October, they'd announce it. The price would go up because that's what prices do. As soon as you announce a dividend, it's included in the price of your stock, any stock. So I'd wait until it got up there so that the percentage was close to what it would be if I held on to it. And then I'd sell the sucker and take the profit, because then I didn't own the shares again. And after it paid the distribution, price would go back down and I could start accumulating again for the next year. So that's what I was doing with these things. I didn't know they were closed-end funds, but they were in my equity side of my portfolio. Then I got a new client. I think it was just maybe 1989 or 1991. And in his portfolio, there are these couple symbols that I didn't recognize. And when I looked them up, I discovered that they were also very high yield. Very high yield. And I asked him, I said, tell me a little bit about these things you own. Usually I find people when they have stuff that's not paying any dividend at all, and I usually convert them out of that into dividend stocks or income securities. But what are these? What are they? And he said they were closed-end funds. So I started studying what closed-end funds were. And, this enormous light bulb goes off in my head and says, wait a minute, these are income funds. This one's got corporate bonds in it and preferred stocks. This one is a municipal bond collection. It's got 236 different municipal bonds in it, and it trades like a stock. So back in the day, when you had bonds in your portfolio, you had to get quotes from the trading desk, and they were always, you'd have to pay a markup buying and selling. This is why brokers used to say each year they'd say you got to sell these bonds and take the loss. We'll replace them with a similar bond, and you have the tax savings. Well, they were getting a 2% fee each way. You know what I mean? So I discovered these portfolios of every type of income security you can imagine, from loans and mortgages and da 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 da. And I started converting the income side of my portfolios, all of them, to these types. I got fired by this one guy in New York, who I had mostly New York and New York State type municipal bonds in his portfolio. And I took profits on them and I converted them to municipal bond closed-end funds. They were literally paying 50% more than he was getting in income, in tax-free income. But on the statement that he gets from the broker, it says he's now in the stock market. And he calls me up and he rips me one because what have you done to my portfolio? I'm all in the stock market. Whoa, calm down. Look at the names of those stocks. Look at what they own. Look what they represent. These are all municipal bonds. These are all still tax exempt. Not only that, you're getting paid monthly tax exempt, and it's I'm compounding it monthly, and it's a diversified portfolio, more diversified than I could ever do for you individually. No, I'm in the stock market, and he canned me. So it was a whole new thing to me. And then finally, so everything was converted, before the dot-com bubble. All my income was coming from closed-end funds. I still had dividend stocks making up most of the rest of the portfolio, except for those two. And then I started looking around in the equity side, and I'd find a couple here and there. And when I had cash and the market might be up and I didn't have a whole lot that was down 20% from the 52 I got, I'd buy a couple of the equity closed-end funds. And I started really enjoying the income that they were producing, because it's quite the same, almost the same today. Today, the equity closed-end funds in my universe, which are 100 different funds, are paying over 10% income.
You, I do want to get to that, but I just want to point something out, because you made a comment a minute or so ago that was excellent to a point that I bring up to people who are in pursuit of income. You mentioned that bonds, you said back in the day, but it's still pretty much this way today. They're complicated to buy, direct issues of bonds. They just are. And
there's still a fee on them too.
Yep, exactly.
Still a markup.
And very few people who think they invest in bonds really invest in bonds. They just invest in bond funds, which have a whole host of complexities that can be quite dangerous, and people don't realize what they're signing up for. Closed-end funds, as you pointed out, are a way to get what people typically seek out of bonds without all of that extra stuff that you can't decouple, and all of the additional assistance that you realistically need when it comes to buying a new issuance or even a secondary market bond. So excellent point. But you just mentioned something that I do want to ask you about, which is your universe. So as I understand it, you have gone through the painstaking task of creating and maintaining a universe of closed-end funds based on how they have performed, mostly income-wise, distribution-wise, and do give monthly reports on how that list has gone. Where did this come about?
It really developed way back in the day when we were doing stock market. I developed at that time what what I called the investment grade value stock index.
Okay.
And that was, all these basically New York Stock Exchange listed, rated B plus or better by Standard and Poor's. The Standard and Poor's way back then had this thing they called the monthly stock guide. Had you ever seen this?
I have actually.
Have you? Okay. So the monthly stock guide listed every possible security from all the exchanges and had a letter rating. And B plus and better was considered investment grade. And if you didn't pay a dividend, you weren't going to be a B plus rated company in book. So it fit perfectly with our guidelines. The quality element, And so we had a list, and we actually had a list of about 225 stocks that met our requirements. B plus and better, dividend paying, New York Stock Exchange, good long time in business, a diversified mix of products, the whole 9 yards. Fundamental things is what we looked at. We didn't look at PE ratio is really kind of a fundamental also, right? And debt to equity ratio. So we covered the bases. But we didn't look at long-term trends. We didn't look at the history of price movement, and stuff like that. And let me tell you this, just because some people make a mistake of how they analyze closed-end funds. Nowhere ever does anybody ever record this distance between the market price of a common stock and its book value. Nobody pays any attention.
NAV, as we would normally refer to it.
Which they call in closed-end funds, they call it NAV. But nobody cares about that relationship between the stock price and the book value.
So you're telling me there's no secret voodoo here. We can't look at the market price and the NAV and predict price movement.
Exactly. So that's the developmental stuff. So slowly I was moving more and more into the closed-end funds on the equity side. And then we had the Great Recession.
Yep.
2008, when we had the big hit. And coming out of it, during it was not a problem because everything was down. I could buy, and I was filling up my portfolio with these high quality companies, and I didn't have any cash that wasn't invested, believe me. But when we came out of it, the way they brought us out of this recession was by lowering interest rates.
Yep.
You'll recall that when we started that, low interest rates were considered, 5% was considered a very low interest rate. Historically, interest rates ranged from 12 and 14% in the 80s to 5%, maybe the lowest ever. So for all those years, that's what we had. And then all of a sudden, interest rates start going down. And over the course of the next 12 years, they went to zero pretty much. Almost to zero. Well, the prices of all the income stuff went up, particularly the municipal bonds. And I actually sold my entire personal and municipal bond portfolio at profits. And didn't go back in for years. But during that time, the stock market pretty much just went up. If it went down a little bit for a little period of time. Nothing was going down 20%. And when you looked at your list of 225 companies, the ones that were down 20% from their 52-week high, you looked at them and said, wait a minute, everything else in the world is up? This guy's down? There's, it's not like the old days, when they all went down. The ones that are down, something's got to be wrong. I'm not buying them. So that's when I started to switch totally to closed-end funds, because you have the luxury of buying a portfolio of stocks and you don't have to buy them. You set in your mind, how much you want to diversify and how much money you want to put in each position in your portfolio. If you know the market's at an all-time high, you just buy less of those stocks because eventually they're going to go down and you can add to your position. So that's what I did. I bought the closed-end funds. I said, okay, typically for this client, I'm starting a position with $4,000. I'll start it with $2,500. For this big client, I usually start a position at $9,000, I'll start it at 6. And that's what I did. And eventually I got everybody, after taking all that time, almost everything, I could take all profits on everything, put them into high yielding, securities that were yielding twice as much income, even than the best of the dividend stocks. And we converted the entire portfolio. It got by, I guess the next real COVID was perhaps the first big time hit we took after the Great Recession. And that was only a 2-month deal.
Mm-hmm.
But still, we haven't really had a significant correction for a duration like almost 2 years.
Yep.
Since 2008 to 2010. We haven't had one.
Mm-hmm. Yeah.
I was wondering if this one was going to get to that proportion, and we are still a little bit in a correction. I'm not like Wall Street. I don't consider 10% down a correction. I get to 20% for me to be a correction. Okay. And we did get that low. But we're not there now.
So
so that's the history of the development.
Yeah.
Okay.
If someone is listening to all this thinking, okay, how do I make the transition? Because I drank the Kool-Aid of the Bogleheads or whatever it is. And I see a lot of people who are getting into kind of the retirement mindset. They're either right at the precipice, they're maybe a little bit beforehand in planning, or they're already there. And they're really, really nervous about what it is they should do because they've spent a lot of time buying index funds.
Yeah.
And they don't have an answer to retirement income inside an index fund. So They're listening to this, they're hearing you. How do they make the transition into something like a closed-end fund portfolio?
The transition aspect is really a big part of my now coaching career.
Okay.
And that's pretty much the type of people I get for coaching.
Mm-hmm.
Look at my portfolio. How am I going to transition from here to there? Yeah. And it's one of the first of the Q&As we did in my income investing community to talk about how do you transition? What do you look for in your existing portfolio? What kind of portfolio is it? IRAs and rollover 401ks and Roths, they're the easiest to transition because there's no immediate tax implications.
Right.
It's the personal securities where people who have been in this buy and hold mode of operations for a long period of time. And I've literally gotten portfolios, $2 and $3 million portfolios that have 5 securities, either 5 indexes or five funds or 1 or 2 stocks and a few of the others, where, they've got 30 and 40% of their portfolio in one security. It's a nightmare. My hair, look at me pulling my thing. Picture me pulling my hair out when I see something like this. I would get people who had a meeting with me 2 weeks from now, and they send me their portfolio for review. I'll send them an email. I say, hey, man, don't wait for the meeting. Start selling some of this stuff. You've got too much money invested in that. We could, planes could fly into skyscrapers in this 2-week period and you'd lose an awful lot of money.
Mm-hmm.
So it's just scary what you see.
You mentioned a community. So you have a community built around the Retirement Money Secrets book of people who...
Around the process, yes. The process of getting from that, what would you call it? I guess you would call it that 4% a year retirement mentality, 4% of capital, or rather 4% of market value mentality, to one that says, I'm going to make more than 4%.
Yep.
That mentality. Yeah. Yeah.
So this is a community people join.
Yes. They join it. They become members. And then they can actually do it themselves just by conversations with other people or by the Q&As that we're developing. We've developed a course. We're about 3 or 4 sessions away from having a complete, I would say, college level, if not master's degree program in income investing.
Okay. In
recorded question and answer mode. So you're not falling asleep to somebody lecturing you about how to manage a portfolio. You're listening to dozens of people participating in a discussion and answer the questions about transition, leverage, income versus equity type securities and things like that. So it's quite a deal.
Now, do they have to be people who go through your coaching program, or can they just join the community?
No, they join the community. They can use my coaching or not. If they use my coaching, it's half price.
Okay.
But my coaching revenues have been reduced significantly from 2024 to so far in 2025.
Okay.
Because fewer people really, once you get it, once you do the transactions, particularly in a volatile period like we've had this year, if you came in, let's say during one of the downturns, you experienced that profit taking almost immediately because we went back up again. If you started at one of the ups and it started to go down, you experienced how you could add to your positions in preparation for the next upturn. So it's really been a very good educational period this first few months of 2025. So it's been a good experience, and the group is very, very supportive. And we don't tolerate any, and we haven't had any, oh, you're stupid, or oh, you can't do that.
Gotcha.
That type of communication just doesn't seem to happen. So it's been good.
And within the group, you mentioned your list.
The universes.
Yep.
We're back to that. Isn't that where we started?
Yeah.
Okay. What are these selection universes? The selection universes, like I said, started initially with owning equities when I was in using individual stocks. But when I started using closed-end funds for all these clients, I had 110 million under management, and it was all going. First, the 50 or so that was in the income asset allocation. First, that transitioned into closed-end funds. So I had to study CEF Connect and other places where I could find those that met my quality type, and the quality things change from individual stocks to groups of stocks and bonds. They had to be, I want them to be 5 years in operation so I can look at the history of the distributions for 5 years to know they're stable. They have to have at least 50 positions inside so I know they're diversified. I mean, I had somebody ask me, why don't you buy this closed-end fund called Cuba?
Okay.
So, yeah, it's real good. It yields a lot of money. It's got one security inside, one company. It's not diversified enough. So you have to pick through. I just noticed this. I really screwed up my mustache. Anyway. So
only the people who watch the video version of this will know. The audio version, no one knew till now.
Okay. So you have to pick and choose things. And it's a whole different set of quality tests and diversification tests. I have something in every possible sector in these universes. And then I keep track of how many positions are in them, what their price and yields are, what their distributions are. And I color code if they've had a lower or a higher distribution. And I keep track of all that stuff. And I had to do that just to manage it so that I wanted all my portfolios under management be different from one another. I know a lot of times on Wall Street, you'll look at a person who has 5 different. I'll get somebody, a client, who's got 5 different portfolios with the same manager. Every portfolio is almost exactly the same. No effort is made to diversify really amongst.
So the selection list, is that something that people go to you to buy? Is it part of coaching? Is it something that's part of this community?
It's it's free in the community. You get it. You get the monthly updates in the community. Actually, we have some people that have adopted this approach and are so good at it that I went away for the month of April basically, and I had 3 of the people in the group actually did the universes for me. For the group. So they're really,
the students
really
become the teachers.
They're really catching on. They're really good. So yeah, each month I go through every one. I look at every price. I look at for example, going through this month, I just did it yesterday for equities and today for the income. The prices were up across the board. So
Okay.
let's say you're going through your list and you find one that's down a point from where it was last month. Everything else is up. So flag, why? So then you go in and you do a deeper dive into that security and you see what's going on. You try to determine if there's some flag that you want. Whoa, wait a minute. I don't think a newbie should go and buy this because there's something going on. So that's the type of review I do every month to make sure. This month, there was news on 2 of them that are going to liquidate. The board has decided they're going to liquidate 2 funds over the course of the next year. So I take them out of the list because I don't want any new member coming in and buying it because it's still paying a good dividend when it's going to go out of business. It's going to liquidate at net asset value. And before it gets to that point, it's probably going to trade maybe a little above net asset value.
Yep.
That's the only time net asset value is important, is when it's liquidating.
Right.
So you take them out and then you find 2 to replace it with. And so when I redo the universes, I send out a letter and I say, my overall experience has been, it's not nearly as bad as you would have thought considering the economy. One would have thought, they have to be cutting distributions because of all the uncertainty. Well, they didn't. In fact, 3 of them raised it and none of them cut their dividend this past month. How about that? So, you point out all these things. So these things have been in business so long that they just are very stable.
Okay. So I realize this question is somewhat of a depends kind of answer because it's dynamic, but we'll preface this, or I'll preface this by saying we're headed into the summer of 2025 as I ask you this question.
Okay.
Somebody adopts this strategy. What sort of yield should they anticipate being able to generate from the portfolio?
From just the portfolio itself, just the distributions.
Yep.
Even at today's prices, equities are somewhat higher than they have been. Income ones are still much lower than they were 5 years ago when interest rates were very low. They can expect to generate over 10%. If they make a diversified if they owned every security.
Okay.
If they owned every security, some of them are yielding high 7%. Even the tax-free income ones are right now, the average of 50 of them is over 7%.
It's I'll add some commentary on that. That's quite mind-blowing. As somebody who's followed municipal income for a while, that's high.
Historically, that's the highest, and it's been several months now that they've been there.
Mm-hmm.
It's crazy high for those securities, and there's 2 really significant thoughts. One, if you're a high earner and you have most of your money in a taxable account, or a lot of your money in a taxable account, putting a bunch of it in tax-frees at 7% keeps your bracket low, helps lower your bracket a little bit, or at least the amount of money that's subject to
doesn't add to the problem, at least.
It sure doesn't add to the problem. And they are at the lowest, almost the lowest level of what we call the risk pyramid.
Yep.
Because states, if they have a problem, they raise taxes.
Yeah.
And they pay their bills. So they're considered very, very safe compared to corporate bonds.
Yep.
Relatively more safe. Certainly more safe than an individual bond because these are portfolios. In that area, there must be an average of 300 different municipal bonds in every individual CEF.
Yeah.
But imagine that 7% tax-free.
7% tax-free, 10%-ish taxable. That's all. Put that in your 4% indexed withdrawal rate.
And
it just...
And let's make it clear. These are not new kids on the block.
Right.
These things didn't just come out like ETFs, which just came out in the 90s. They're only 25 years old, people. These things came out in the 1825 area. A couple 100 years ago, these things were around. They were alive and kicking back then. Before mutual funds were around, they were around. So these aren't anything new. They're just something that Wall Street chooses not to make people aware of.
There's several additional rabbit holes we could probably go down with that, but in the interest of keeping this podcast at its normal run length, which we're already over, I think we're going to have to call it there. Steve, thanks a lot for joining me. For people who are interested in Steve's book, Steve's coaching, the community that he has created, we'll have links in the show notes for you to follow to get more information on that. Absolutely, an open invitation exists for you to come back. We can dive a lot deeper into a bunch of different subjects on this, and I hope to do that at some point in the future. That's all the time we have for today, I'm afraid, but have no fear. I'll be back next week with more tips and tricks to help you build a solid income with your retirement plan. And until then, please remember, real wealth doesn't just add up, it writes checks.